Welcome to Between Two Chairs, Demystifying Commercial Real Estate, the podcast that brings you the latest insights and trends on the South Florida commercial real estate market, with your hosts, Fernando Arencibia Jr. and Jennifer Woolman. In each episode, we dive into the world of commercial real estate and break down complex concepts to make them accessible for everyone. Whether you're a real estate professional, a curious investor, or just interested in the South Florida market in general, Between Two Chairs is the podcast for you. So pull up a chair and join us.
Welcome, everybody, to another episode of Between Two Chairs. My name is Fernando Arencibia Jr. Thank you all for being here. And with me, as always, is the very fresh, very forward-thinking Jennifer Woolman.
No, we can't take that title away from Inez.
From Inez? No?
No, she's the forward-thinking, forward-thinking creator.
It's contagious. She has drilled that into us. So
That's true. It was a great hashtag.
We're part of the forward-thinking movement.
That's true. And we're going to make all of our listeners forward-thinking too, because we're going to get them thinking about real estate. Yeah. Across the board.
Absolutely. No, this is what we enjoy. And really, I think that the topic today, which has to do with capitalization rates, which has to do with, the financial evaluation of an investment vehicle, is something that we talk about every day with our clients or how we look at properties. And so I think it's going to be a lot of fun to have this chat.
Agreed. And so there are a lot of different ways to evaluate investments. You have the cap rate, you have IRR, you have cash on cash, just among others. But today we're going to focus on cap rates just because that's what you hear the most. Right. And it's so easy to do. That's one of the reasons why I think we hear about it so often, is it's one of the easiest metrics to use to quickly evaluate back of napkin in your brain math that, kind of the cowgirl math that Dalee talks about all the time. Super easy math to be able to compare properties across different asset classes or even within the same asset class, different geographies, et cetera, just to give an investor an idea of whether the property, the investment deserves a deeper dive.
Absolutely. So how would you like to get started?
So I guess with a definition would be the way to start, right? Because we're supposed to demystify. Sure, so what exactly is a cap rate? So kind of as we alluded to, cap rates are a quick and easy way for an investor to determine an expected rate of return on the investment because you only need two data points. You need the net operating income and the current market value of the property. So basically NOI and sales price, right? And then once you have those two numbers, you calculate your cap rate by dividing the NOI generated by the property's current value or what the investor wants to pay. So you can either use the asking price or what the investor wants to pay. Also, if the investor knows that they have a certain cap rate going in, they can reverse the math, right? To come up with, okay, if I know that I want a cap rate of 5.9, then how much am I willing to pay for this property if the NOI is correct?
Correct. So if I may, before we dive into cap rate specifically, which I think it's great that we're specifying that because it is true that it is the metric that most investors, it's the language of investors when they call you and they're evaluating an investment vehicle. But if I just can bring it back to a little bit more of a macro perspective, people, when they invest in a real estate property and a real estate building, they are they're not just investing in the building, but they're investing in the income stream that is tied to that particular building. So we're really speaking about people that are purchasing real estate as an investment, right? Rather than an owner user that is going to use it for their company. So that's one thing that is, an important approach is that when investors are looking at real estate, commercial real estate investment as an investment, they are looking for what is the income stream that property is generating, hence the net operating income. The other thing that they take into consideration is something called the time value of money, which is really what all these things are about. The internal rate of return, if you're going to use a GRM, gross rent multiplier, or a cap rate to determine that return, what they're looking for is, if I put X amount of money into investment A for X amount of time, what is going to be the growth of that money over that period of time? And if you have investment A and investment B, and the time value of money that you put into investment A is higher than investment B, then you understand that if you take investment B, then there's an opportunity cost, right, that you're losing out on the growth, right, of investment A. And that's kind of how investors approach the market. And real estate, we are competing for capital dollars as an industry, right? Commercial real estate competes from capital dollars, not only from real estate, but from bonds, stocks, there's all these other investment vehicles. So, just overall, what we're evaluating here when we're talking about cap rate is the income stream that is generated. This also allows an investor to look at commercial properties, to your point, across asset classes, and just look for, okay, this industrial building is generating X amount, so this is the income stream that I can gain here, versus this multifamily building, versus this office building, versus this retail shopping center. And so, it becomes really about that income stream is kind of the way for you to be able to compare apples and oranges through a continuum that is equal among all five, which is really the income stream.
Correct. So though a lot of people use cap rates, it's all perspective, right? We always talk about perspective. Yeah. So if I'm a seller, my cap rate might be significantly lower than if I'm a buyer because, right, I'm trying to push my valuation higher. So I might try to push that cap rate lower by saying, oh, well, I'm not going to include my management fees because the buyer's going to self-manage. Or you use your current NOI. In your NOI, you have your current property taxes, but when the buyer buys, those property taxes are probably going to be different. So there are some nuances to a cap rate as the only source. I mean, it's never the only source. It's usually just the initial first glimpse to determine whether an investor wants to move forward. And then they also can have an entry or beginning cap rate. And then they also need a cap rate if they're doing the whole evaluation for when they exit the property. And if you remember in Delee's interview, she said, look, if I buy a property at a 6 cap and I sell it at a 6 cap 20 years later or 30 years later, because she's a long-term hold investor, she's like, I don't care if my cap rate's the same because in the meantime, I've pushed up my rents, I've paid off my building, I've done all this kind of stuff. So some of the limits with cap rates, in addition to really needing to dig into the NOI and what the seller is included versus what an investor might include, are that because it uses net operating income, it doesn't look at a bunch of other numbers that need to be taken into account when you're really doing a deep dive, right? So NOI is pre-tax, so it doesn't include whatever the investor's tax bracket is. It doesn't take account any debt, right? So your interest payments, principal payments, capital expenditures. It doesn't take into account depreciation and amortization. So again, the cap rates are used pretty much as a snapshot to look at, to your point, the overall investment picture and determine whether that property deserves a deeper dive or if you're better off putting your money into stocks or the long-term market or a different property.
Well, to your point, there's something called the discount cash flow model in which you're evaluating the investment from 4 perspectives. One would be if you buy the property cash before tax, that is one of the ways to evaluate it. Then if you do pull a mortgage and you are able to, what we call leverage the property. So instead of putting 100% of the funds, now you're going to put, let's say, 70%, 30% of the funds, the bank brings the other 70. So now you evaluate based on the debt service ratio of that loan. Then you do the same thing with if you buy cash after tax, or if you have a loan leverage, after tax. So there are multiple ways for you to be able to understand exactly what that vehicle is going to generate. One of my favorite metrics, and I think it's a favorite for people, is to look at the internal rate of return. The internal rate of return is basically you're evaluating what every dollar that you put into the investment is generating every year that you are holding that investment, right? And then because you're taking into account, to Delia's point, because you're taking into account not only the acquisition price, but also the disposition price, then you really get a bigger picture. But those things are difficult to do when you're just evaluating a property and you're just, doing back of the envelope, calculations. It's easier for you to take the net operating income divided by the, acquisition price, and then it gives you a cap rate. So that's why it's so popular, because it is very easily accessible for you to at least have an idea of where you're going into. I know people that just look at the NOI divided by the asking price, and they know right away whether it's something that they want to investigate further or not. But investigate further, if they choose to, they must, because it's an easy equation, right? NOI divided by price. So because it's an easy equation, let's take the one side of the equation that requires more study, which is the net operating income. To your point, we have people that are self-managing the property. They don't pay a management company. We have people that have owned the property for a very long time, right? Because what do you have in the net operating income? You have all of the revenue that comes in to the property minus all the expenses, right? And so what happens there is that, hey, if I bought the property 20 years ago, my tax rate is really, really low. So of course, that makes the net operating income, much better. At the same time, my rents might be low, right? So an investor is always looking at, okay, how are my expenses going to be different and how they're going to grow? One of the clear ones is taxes, because the property tax rate the property taxes on the property will adjust. And the other thing is they're also looking at, well, what is the income? Is this real today, proof of concept income that is being received? And can that income, increase? One of the things that it's a little bit of a, I don't know if it's controversial, but I just know that there are differences in the way that people market properties, is that we have a lot of properties that are being marketed with pro forma numbers. And I think we should explain that. Pro forma basically is, what you would expect the property to perform at, basically how the rents can be if they were at market value.
Right. It's potential, not actual.
It's potential, not actual, right? And sometimes the problem with that is that you have some people that are marketing the property, they are pro forma the income, but they're not pro forma the expenses. So you're not really, able to compare apples to apples. I'm of the belief, and I don't know where you lie on this, but I'm of the belief that I'd rather just give you, this is the way the property is operating today. This is the income. This is the expenses. We could have a conversation about potential, and believe me, the seller has taken that into account when they're deciding on the price, because of course there are other factors that are involved in determining a price. But I'd rather just give you the raw today numbers. Here's where we're at, and it is up to the investor to do those investigations as well, and to be able to to assess whether that's an investment that they want to make.
Right. The other thing a lot of sellers don't put into the NOI calculation, which should always be included, is the vacancy rate, right? Because, for example, if they've owned that property, to your example, for a really long time and they have no vacancy because the rents are low in a multifamily or in a commercial space, then all of a sudden they're like, oh, well, we have no vacancy. But that doesn't talk about what is the overall vacancy rate of the market, or what happens if you have the typical vacancy rate when the new buyer bumps up rents, et cetera. So it's really important to do your due diligence on what is and isn't included in, to your point, the current NOI, not the pro forma. Yeah. And then where the buyer thinks the NOI is going to be based on their ownership, right? Based on the new ownership, and then compare those.
So the other thing that people miss out is that when you pro forma a property, sometimes in order for you to achieve those numbers, you have to do a capital investment into the building. So now, not only am I acquiring the building at an X amount, but now in order for me to really get the rents up so that the numbers make more sense or that, they're more attractive, now I got to invest an additional significant amount of capital in order to do that. I've seen people do that in Little Havana where they're buying a building. Well, in order for them to get the rents that they want, now they got to do central AC, they got to change the windows, they got to, make updates to the building that they were perhaps not considering, right at the very beginning. And then when they go to market, they want to get almost, they want to get dollar for dollar more than what they invested in those capital improvements. Well, that's not, that doesn't quite equate, right? But, it's an important component, and that's why so much time is really invested in the net operating income. Mm-hmm. Now, let's talk about something here, which I think is what is really valuable about the cap rate, which is that over a period of time in an area, in an asset class, you can determine what is the going cap rate in an area. So what's great about it is that, let's say the going cap rate in an area is 5.4%. When you're evaluating properties in that area, and this is very, specific to asset class, I believe, and specific to location, but you can really, within very small margin of error, be able to evaluate whether the property is overpriced, just from a quick look, right, view, or if it has potential to go there. And so that's, I think, where the biggest value is, because you get to understand what is the going cap rate in an area. And that's what every property that is on the market is competing against.
Right. So, for example, the current market cap rates for fourth quarter of 2023 for Miami, Fort Lauderdale, Pompano, greater metro area is 6.9% for office, 5.2% for multifamily, 5.4% for retail, and what am I leaving out? Industrial, 5.7% for industrial. So, given what's going on in the country, those numbers are still very low. But what I found interesting about that is that with the exception of retail, which remained the same year over year for fourth quarter 2023 versus fourth quarter 2022, was that all of the other asset classes ticked up just slightly. Mm-hmm. But in every asset class, all of the rents went up.
Right.
So how interesting is that? That, the cap rates are slowly moving upwards, but the rents aren't coming down, right? The rents are moving upwards. Right. So then that tells me that expenses, obviously, and trying to push the market, the slow down in sales and everything is what's making cap rates push up a little bit further, which makes sense, right? Yeah. Because especially anywhere where there's triple net leases, most of them still aren't, 100% absolute triple net leases. Sure. But so with insurance going up and property taxes going up for current owners.
But here's something that is always very important. So when I look at cap rates, when I look at investment properties, I'm always also, going back to look at the 2-year Treasury yield, the 10-year Treasury yield. And the reason for that is because, so like I mentioned, we're competing for capital dollars from different investment vehicles, right? Mm-hmm. And so if we're only looking at the income stream, there is a risk factor when you're buying real estate, right? That's just naturally. You have a building, it has to be upkept. There's, fluctuations in the market. It could appreciate, it could depreciate. We know long-term appreciation is there, right? And we know the value of the investment. But the question is, if I'm going to buy a multifamily building at a 5.2 cap or 5.4 cap, right? But my 2-year Treasury yield is at 4.927 as it is right now, as I'm looking at it live, I can put the money in a 2-year Treasury, make the 4.9, and I am guaranteed that I have no risk. No headache, because I'm gonna make that money, right? So why would I do it only for an extra 0.5%, right? And so those kind of things, interest rates and the 2-year Treasury yields, all those things put downward pressure on cap rates. But there is a reason why people still buy real estate under these conditions at a 5.4. number one, it's very market driven. So they see the value of the market. Number two, there is what we talk about, which is the internal rate of return. And so sometimes people will say, well, you could have a property that is on paper generating a 6% cap, but the internal rate of return might be 14, 15%. That's every dollar you put in there, because unlike the bonds, you have the power of leverage, right, in real estate. So I could buy this property for a lot less cash output from me because of the ability to mortgage it, right? And when I do my study and I look at the investment with leverage after taxes, and I look at the internal rate of return, and I create a holding period, 7 years, 5 years, 10 years, however it is that your investment hypothesis is leading to, then you could see that, okay, my rate of return and my investment of every dollar that I put into it can be significantly higher than what the 2-year Treasury yield is.
And it doesn't take into account like all of the tax sheltering benefits that you get from owning real estate, right? So that's why, I think in addition to IRR, better than cap rate is the cash on cash return. Right? Yeah. Because that basically calculates how much money the money that you invested earns, right? Correct. So that takes that into account a little bit better. And that's why sometimes people are buying, and I think you made the comment that the high 10-year Treasury pushes down cap rates. I think you meant means cap rates have to go up, right? Yeah. Right, cap rates would have to go up because just for our listeners,
on price in order for cap rates to go up, unless the revenue really is increasing, which, currently that's not really what we're seeing.
Right. So just to clarify, so the lower the cap rate, the higher the valuation on the property, and vice versa. It's an inverse relationship for our listeners. So that's kind of cap rates in a nutshell. If you're either an agent or a seller or an investor starting out, now you know a little bit more. Hopefully we demystified instead of confused more, but it's just, back of the napkin and to an interview we did with Nate. So obviously we've mentioned Dali a lot. If you haven't listened to that episode, listen to our interview with Dali Becker. And now I'm going to mention Nate Korn, a multifamily investor. I mean, he said, because we had asked him in this market if there were any deals, and he said, one, there are always deals, and two, even at a 4 cap rate, there is a deal out there that he was looking at that still made really good sense to him, even though a 4 cap rate is significantly below, right, the 5.2 of our area, and significantly less than he can get in the 10-year Treasury. So for sure. He's obviously doing a much deeper dive than just cap rate. So
but I will say this, that to your point about Nate, is where I think people fall into an issue is when they have to continually, when the property is really not cash flowing. That's where the difficulty is, right? Because you want to be able to cover, the property has to make money. The property has to cash flow. And so, I've seen deals, for example, in Miami Beach, right, in South Beach, where people are buying what we call trophy properties because of the location, because of the market. I saw one at a 1.9% cap.
But let's talk about that, because I have a buyer who buys all the time, multifamily, and her properties never cash flow. Because she goes in value add, they cash flow eventually, but when she first buys them, she assumes 2 years, no cash flow. Wow. She goes in, they're grossly under market, and she guts the buildings. She puts in impact resistant windows. She puts in brand new roofs. She puts in everything.
Back up for a second just to say that requires you to empty the units.
Nope, she empties them. So she does the major stuff. She does the roof without vacating anybody.
Sorry to interrupt. The gut renovation, you're saying as the units
become vacant. So she'll do the renovation that she does on the exterior envelope. She can do whether people are living there or not. But then she updates the interior units, to your point that you were making about if somebody does a pro forma cap rate based on increasing rents. So then she goes in, and her rents in year 2 or 3 are double or triple what they were before. still market rents, but because she's buying properties that were so grossly under market because somebody's owned them for so long, they're also in bad shape because they haven't had any capital improvements. Correct. So she never buys a property that cash flows in year one. So for her, cap rates are, kind of don't really mean anything. Yeah. So I just wanted to clarify that. And those properties are value add properties, right? Most value add properties don't cash flow when you first buy them.
But I'm really curious because over the last few years, the demand for rentals has been so high, and there's just not enough inventory. That I know people that went into an investment of a multifamily with the intention of doing capital improvements, but people didn't want to leave, so they increased the rents. They got the benefit without making the capital investment, just because of the nature of the supply and demand pressures that were in the market.
And that's where every individual investor's kind of their game plan comes into play, right? This woman's game plan is always she buys low rent properties and properties that need capital investment. And yes, she could jack up the rents without it. Yeah. But her formula is no. Yeah. I'm going to go in there. I'm going to fix them up because she doesn't want the headache. She doesn't want to be worrying about her properties during hurricane season. Yeah. She doesn't want the tenants calling all the time that this doesn't work, right? Yeah. So her formula is I buy stuff that's been owned a long time, under market, needs capital investment, and then I go in and I update it, and then I'm good to go. Exactly. Next project. So again, that's where the individual investors kind of game plan. And Nate also, he has very specific parameters in terms of what he buys, and he kind of has his own investment formula. There are things when I buy in terms of either market or asset class that I have stuff that's non-negotiable. It's the formula that I use to buy property. Correct. So
and that's the other side of the equation, right? For an investor is they're looking at the income stream, but they're also looking at understanding that product. I had one of my first transactions in multifamily was this 15-unit apartment building that was built in 1925 in Little Havana. And so what happens is when the owner bought the property, he vacated all 15 units. And then he did a full gut renovation of the building. And so what he realized was that the biggest danger to these 1925 properties was termites and water damage, because the pipes were known to break down, right? So he redid all of the plumbing, brought it all the way out to the connection of the city. Then the wood is very good because it's Dade County pine, and for people who don't know, who are listening around the country, very strong wood, right? Not very attractive to termites because of how dense and how difficult it is to chew through, but that can still create damage. So he set it up, and then so he knew, as long as I take care of the water and I take care of the wood, then this property will last. He did impact windows, concrete roof, and owned it for 10 years with very minimal additional investment over that 10-year period, and then was in the disposition of it. So I remember him telling me, it's not a huge gap between what I bought it for and what I sold it for, but then we did the calculation of the internal rate of returns. Man, you've been earning consistent income for 10 years. You have to take that into account. Right. There's an incredible thing. And at the time, the cost of construction was so low that he only spent $10,000 per unit in order to, which, it's significant. It's $150,000 10 years ago, but it still is, compared to what people are spending now to renovate a unit, it's, it's night and day.
So before we get to fun facts, just because of what you just mentioned and, emptying out a building, there's a great program if you ever need help with evaluating investments on RPR called Valuate, and you can play with all different scenarios. So, for example, with multifamily, what happens if I vacate 100% of the building like your person did and spend the money and do all that versus doing what the investor that I know does, where she does it one by one. So there are a lot of products out on the market to help you do that, so you don't have to do it longhand. Exactly. So anyway, do you have a fun fact?
I was reading this thing about, because we're talking about really supply and demand always plays a role into everything that we're discussing. But so Elliot Eisenberg, the multi-economist, had this thing, and I thought it was interesting. And he's really making a commentary that the White House created a pilot program that was designed to save homeowners money by waiving the requirement for title insurance on some refinancings by some lenders. And what he says is that that's kind of ill-advised, because they're trying to increase demand, but they are not addressing the supply of the supply side. And I think that that's the biggest argument today, which is that we need to really address the supply side by promoting more residential construction and incentivizing that, rather than worried about reducing the cost, which we know increases more demand. What we need to do is the increasing of the supply is going to allow for the cost to level out and for those things to happen. But we really need more supply.
And I think the type of supply we need is very important. There are a lot of first-time home buyers out there that want to buy a home. Mm-hmm. Most of them want to buy in the area, in or near the area where they live. And what we're building is a lot of rental communities. And the reason we're building the rental communities is because these people can't find what they buy. So my caution, especially as a realtor, but even more so as a U.S. citizen, is that we need more. We need to make sure that we're always increasing the number of homeowners, or at least the numbers of properties that a homeowner can buy. And that gets us into a whole bunch of different issues, like, all of these, even though it's not a huge percentage of the market, the rent-to-own communities. And
definitely, this is for
build-to-rent communities. Excuse me. This
is for another podcast, but there definitely feels like there's a lot of pressure in the United States that how home ownership is under attack. That there's a lot of forces that are, perhaps looking at the world and looking at the United States, from the England model, London model, where the majority of people are renters and only a smaller percentage are homeowners, and that's something that we definitely need to address, because home ownership is incredibly important.
Well, it's the foundation of our communities, right? It feeds everything. Retail follows rooftops, all of that, and a homeowner gives more to their local community than somebody who's just passing through. And I'm going to throw in some, a personal stat real quick. So I have two of my sons. Obviously, my daughter, but so I have one son who lives in Palmetto Bay, another son who lives in London. We were together, and they were complaining, and both of them were complaining about their rents. One of them pays close to $6,000 for 2,500 square foot, 3-bedroom, 2-bath home, pool, yard, etc. In Palmetto Bay, Florida. The other one pays the exact same amount for a 900 square foot apartment in London. So he doesn't want to hear his brother complain about the rents. I'm like, I guess, again, going back to our story perspective. So in wrapping up, my fun fact is, according to Cap Rate Index, the zip code with the highest overall cap rate in the Miami area at 9.44%, which is a huge cap rate, is zip code.
What? I'm sorry? For what?
Overall, all asset classes within the zip code in Miami, 9.44%. And it didn't tell me the year, so shame on caprateindex.com, but thank you for the number, is 33179, which encompasses parts of North Miami, Oju, and Miami Gardens.
Wow.
And for those of you who don't know Oju is an amazing, I love this little pocket in between Aventura to the North Miami Beach to the south, and Sunny Isles to the east. And it's where Haulover Park, Reynolds Park is. It's this beautiful little pocket.
That's lovely. That's awesome.
Thank you for joining us and for going on a drier discussion of cap rates and everything else. But, we're here to demystify and provide information.
Absolutely. I hope you all found it valuable. We appreciate you pulling up a chair and joining us. And until next time, bye.
Bye.